So now over the last topic, which is market value over time. So here, like, these are like the summary. First is inflation, prices rise over time, reducing purchasing power. Market downturns, short-term dips are normal, long-term trend is upward. To protect against this downturn, limits losses during market drops, but also caps gain. Government investments like treasury bills and bonds offer low risk options during uncertainty, and there are two small stock types: small stocks, which allow for high growth, high risk; large stocks, which are more stable and slower growth. So now moving on to the first category, which of today's seminar, which is understanding taxes and how to save wisely. So what is a tax? The basic definition of a tax is that it is a mandatory payments to the government that fund public services. The purpose is to support society and government functions like roads, schools, and healthcare, etc. The goal of taxes is to minimize. The goal is to learn how to minimize taxes legally, and you get to keep more of your money. And a key concept here is tax efficiency, which is managing your money to reduce taxes and grow your wealth faster. So how do you pay your taxes smartly? What is the reality behind taxes? Most people pay thousands of taxes every year. Without smart planning, taxes can eat away your income and savings, and learning how to legally minimize this is essential for building wealth. So here are some examples of tax inequality and how legally minimizing taxes makes such a big difference. So Warren Buffett pays a lower tax rate than his secretary. He earns most of his income from investments and are taxed at lower capital gain rates, and uses donations in tax efficient accounts to reduce taxable income. For reference, he is a billionaire and he pays less than like one of his employees, which is crazy. And Donald Trump paid 750 in federal income taxes in 2016 and 2017. Um, which compared to ordinary Americans, that is like a huge difference because they usually pay 10K to 20K a year, while Trump only paid 750. And then this is because most Americans, like ordinary citizens, their income are mostly from wages, which are taxed at higher rates than investments, while um, investors like Trump are use real estate losses, business deductions, and depreciation to offset income. So now moving on to the three main types of taxes. So there are income tax, capital gain tax, and consumption tax. Each type of tax affects your money differently, and understanding them helps you make smarter spending and investment decisions, which legally reduces your tax burdens and maximize your savings and compound growth over time, which we will get into later on in these slides. So what is income tax? It is a tax on the money you earn from working, like wages, salaries, tips, bonuses, etc. This applies to two types of forms. We will go over them later. Employees, which are under W-2, and freelancers or contractors under 1099. And so basically, the more you earn, the higher your tax bracket is, but deductions and credits can reduce your taxable income. So, well, now moving on to capital gains tax. What is it? It is a tax on profits from selling investments like stocks and real estate or crypto. This applies to short-term gains, which are held in within a year, which are taxed like regular income. Long-term tax held more than a year, which are taxed at lower rates. This means that when you're investing in long-term investments, it can reduce the amount of money you have to pay for tax or your tax bill. So some examples of this are stocks, real estate, crypto, and mutual funds. Now moving on to consumption tax. What is it? It is a tax on what you buy. This includes goods and services. In United States, it's mostly the sales tax or mainly the sales tax, and in other countries, it's the value-added tax. So examples of this are like groceries, electronics, clothing, and eating out. So now moving on to compounding impact. So compounding is when your money earns interest, and over time that interest gains more and more, and then interest earns interest. So your money is basically earning its own money for you. So taxes and what's compounding and its correlation to taxes, it's that taxes reduce the amount of money that stays invested. Less money invested means that there is less growth of your investment over time. Even a small tax rate can significantly reduce your long-term gains. So for example, if you invested 10K over 30 years at an 8% annual return, so if you this is at this rate, your investment, if it was tax-free, Roth IRA, then you will get over 100K in return. However, after those 30 years. However, if it was taxed annually at around 22%, which is the usual rate in the US, uh, you only get around 61K back, which is almost half of the money you will get if it was tax-free. So now moving on to the two types of tax forms. The first one is W-2, the employee form. Traditional employees working from companies usually use this form, and some features of it is that employers automatically withhold taxes, like federal, state, Social Security, Medicare, and the employee receives a W-2 at the end of the year showing total earnings and taxes paid. So some pros of this that taxes are handled for you. The employer automatically pays those taxes and deducts that from your paycheck before it even is handed to the employee. And it's also way easier for the individual to file. However, there are some downsides to this. Fewer deductions are available, and there is less flexibility in income reporting. Um, there is the second type of tax form is the 1099, which is the independent contractor form. Freelancers and self-employed individuals usually uses this, and some features of this is that no taxes are withheld. The individual themselves are responsible for paying their own taxes. They receive a 1099 form after from each client who paid them $600 or more. Some pros of this is that they have more tax deductions like home office, equipment, travel, etc., to decrease the amount of money they have to pay for taxes, and there's greater control over their income. However, there are also some downsides of this, which are that you must track and pay your taxes yourself. It is really a hassle to some people, and you may owe quarterly estimated taxes. So, what is the main difference between the W-2 and the 1099? So, for W-2 for employees, they pay their taxes first and then spend later. Their boss automatically withholds taxes from each paycheck, and you receive your net income, which is after the taxes, which is easier to manage but fewer deductions. Or basically, there are less leeway around how you can decrease the amount of taxes you pay. So, for example, if you're in 2000 a month, with taxes withheld, you take home 1,600. And for 1099, they spend first, pay, and then pay taxes later. They receive the full payment upfront and are responsible for tracking and paying taxes themselves. There are eligible for more deductions, like home offices, supplies, travels. And for example, if you earn the same amount of money as before, like 2000 a month, and you keep all that $2,000 and you pay those taxes later, often quarterly.